Good afternoon, everyone. While we give everyone a minute or two to settle in to today's session, please enjoy this video from today's presenting sponsor, Accenture.
With a bang, energy and change came to every part of our universe. Seismic or small, it continues.
Change is all around us, shaped by technology and human ingenuity. We can make it work for you and your business.
Okay, hi everyone. I'm Margaret Mueller, the President and CEO of the Executives Club of Chicago. Thank you for joining us today for this very exciting conversation. I want to thank our very generous sponsors for today's program. So again, our presenting sponsor, Accenture, as well as our program sponsors, Discover, Northwestern Medicine, and ZS Associates. Thank you all for your ongoing sponsorship of the Executives Club. A quick note, in case you're new to the GoToWebinar platform, if you hover your mouse in the top right-hand corner, you'll notice a small orange arrow. If you click on it, you can access handouts for today's program, the agenda, some information on upcoming programs, and there's also a pop-out box for questions where you can submit questions to the panel. Please do that. We're going to leave time for that, so we'd love to hear your questions. If you have any technical issues, just email programs@executivesclub.org. So I'm really excited to hear from this panel of tech experts on the outlook for startups in Chicago and the Midwest, as well as their forecasts and trends in fundraising, exits, and IPO activity. Here to say a few words and to introduce our panelists is Chris DeHunt, who's the Managing Director for Technology in the Midwest at Accenture. Chris?
Thank you so much, Margaret. Good afternoon, everyone. As Margaret said, my name's Chris DeHunt. I lead our technology practice in the Midwest. In addition, I'm our global technology lead for our health industry practice. Accenture is proud to be a presenting sponsor of the Tech and Innovation Series and to support the Executive Clubs of Chicago. At Accenture, as you can see, technology is at the very heart of everything we do each and every day. Whether we're assisting our clients on their cloud strategy and accelerating their ability to operate in the cloud, to transforming our clients' supply chain operations, to even mapping out the unique technologies for the future of food. We're pleased to sponsor today's conversation that features a panel of several of the leading experts in the technology industry. Just like these panelists, Accenture is at the forefront of advancing the technology landscape in Chicago and beyond. I'm thrilled to welcome today's discussion Brad Feld, co-founder of the Foundry Group, Brad Keywell, founder and CEO of Uptake, Jay Chuckawat, founder and former CEO of Fieldglass, and Dana Wright, managing director of Math Venture Partners. And last, Steve Kaplan, faculty director of the University of Chicago's Polsky Center for Entrepreneurship and Innovation, who will be moderating today's program. As a reminder, use the question box on your control panel if you have any questions for today's panelists. Steve, over to you.
Great. Well, thank you, Chris, and thank you, Margaret, for inviting me to do this. I hope everyone watching is safe and well and stays that way. And today you can enjoy a panel with 4 terrific panelists. And I am looking forward to hearing what they have to say. But first, what I'm going to try to do is give you some macro thoughts about the state of tech. And then we'll move on to the Q&A. And I would say that despite the chaos of the pandemic, the political turmoil, etc., tech has had a surprisingly good year. And in fact, it's really had a surprisingly good 10 years. And I've got a question mark there. This is a golden age for tech. I really don't think I should have left a question mark. And let me just show you why I'm positive and why I want to hear whether my panelists agree with me. So next slide. So first, we've seen what tech has done in the public markets, and it's pretty astonishing this year, at least through last week. Tech stocks were up 37%, which completely dwarfed the S&P and the Russell. So public stocks, and we know that the big technology stocks are drivers of that. Next. But it's not just the tech stocks. The IPO market, despite the pandemic, has been spectacular this year. And you look at those numbers in Q3 2020, it's like the second best quarter for IPOs since the financial crisis. And Q4 or next Q1, you've got Airbnb, DoorDash, Instacart, others to follow. This is like phenomenal for venture capital exits, and is something that I think a lot of people were not expecting. Okay, next one. Then what about venture capitalists? So we've got two, three, four sort of venture capitalists here, people invest in tech. You will be very interested to see the next slide. That slide, the black line, shows you the average performance by vintage year of all venture capital funds raised in the US. And what that ratio is basically saying take $1 and put it in a venture fund and compare it to $1 that you put into the S&P 500. And you can see that vintages post 2007, all those vintages crush the S&P 500 on average. And actually the median fund beats the S&P 500 on average. And that's sort of the amount there is like 40% better than the S&P. And remember, the S&P did well during this period, and the venture capitalists have done even better. And if you did that relative to the Russell 2000, it'd be even higher. And that might be the better comparison because it's smaller funds. So venture has been doing equally well as the public stocks. Next. And now let me tell you a little bit about what venture capitalists are saying. And this is something I did over the summer with friends at Harvard and Stanford. We surveyed about 1,000 venture capitalists last summer. So we just surveyed everybody who matters in the world on venture capital. And here's what they told us. Next slide. So we asked them, how are your companies doing? And turned out that 10% were, in the ICU. About 38% were sick but okay, and actually 52% were not affected or positively affected. So it was sort of there was variance. It was not as bad as we thought. And then next slide, when we asked them to sort of say what it would end up doing, they basically said it would not affect our performance, which was shocking. And that was in July. Markets have improved since then. So I think what you're going to see on the venture side is actually that this year in the pandemic is maybe a net positive. And you do see there's variance. Some funds are hurt, some are helped, but it's strangely or remarkably positive. Next slide. Then, look at investment. Their deal activity, it went down in Q2, came back in Q3. And slightly down overall, but not a whole lot on the venture side. Next slide. And valuations haven't been harmed too much either. So that's a look at valuations. And next slide. And we asked them, what kind of returns are you looking for on the venture side? And we had done a similar survey 4 years ago and asked the VCs the same question, and no change. They're looking for good returns and similar to what they looked for 4 years ago, and by the way, which they seem to have delivered. So next slide. There we go. So that's the data, and the bottom line is we look like we are doing well on the tech side, and you can argue it is sort of a golden age. And so my question is, what do you think, our panelists? What have you seen in the pandemic, and how has it affected your portfolio? And why don't we start with Dana and Jay, who are more Chicago focused. Dana, you want to start us? What have you seen?
Sure. Well, it broadly follows kind of your pie shape there. What I would say is it very specifically tracks with whatever kind of customer that you have, at least in our portfolio. So if you are focusing on B2B sales in a SaaS portfolio company, maybe that got pushed out a year in terms of growth. You didn't lose too much, but you didn't gain too much. If you're in a transaction kind of business that's consumer driven and that particular consumer behavior changed. So think about locally Spot Hero. Spot Hero had a massive decrease in their revenue for a short amount of time. It's a transaction marketplace kind of business. It was drastically down. And then we've seen that build back up over time. So it's very customer specific. It's very business model specific. But generally, you know, the adoption curve has increased in terms of technology, and trends that were happening before have been accelerated. And that's generally good for our space.
Jay?
So, you know, I would answer that from the point of view of an angel investor, not a VC, even though Dana's managing some of my money ably, I would say. And I would say it's been a positive, but that may just be because of the timing of how things have worked out. So if I had to take a broader view, I think it's going to be mixed. The biggest beneficiaries have been you know, the firms that are in the logistics space, for instance, and there are a number of them in Chicago that are prominent, that are venture backed. This has been a bit of a hub for logistics, and they've done very well. Others that are, you know, the local equivalent of the work from home stocks, and in that I would put our one of my favorite firms here that was founded, that was QB, that was recently acquired, and
it had its start at University of Chicago at the New Venture Challenge. So
that's right. They were started here. Kickstarter funded them, and they didn't raise very much money, which is the other secret to actually making a good return. But they tripled their revenue this year to 75 million plus. If you can, you know, they were 25 last year, 75 million plus, and then the acquisition, so it was good timing. So when I say the portfolio was positive, you know, the buried in there is these little, you know, bits of luck that you end up getting. I think in summary, what this has done is it's sort of exposed the truth of the business models of companies. And if they hadn't figured out a business model or made it stick somehow before the pandemic, then it was not going to get better. So I'd say there's going to be sort of less good things happening to some of those firms. It'd be difficult to get funded.
Interesting. Brad Feld, you're more national than Chicago. What are you seeing?
Well, fortunately, my favorite number is 3. And it seems to be the way that most of these things end up getting categorized because of red, yellow, green. I think Dana said it pretty well. I'd reinforce it with one nuance. I think that there was a 2-month period in sort of mid-March to end of April, mid-May, that was just extraordinary amount of uncertainty. It included the time frame for the lockdowns. And it was a moment in time where there was a lot of sort of recategorization of where you were. Even at the end of May, there wasn't necessarily clarity on what the future was going to look like for your particular company, but you at least knew which of those 3 categories you were in. Were you a company that was going to benefit from the pandemic in terms of the types of business that you had and the types of products or services you delivered? And we've seen that, you know, many companies that have had extraordinary growth as a result, and you know, we're seeing some of the outcomes of those companies now in the private markets. Roblox being an example of one that filed yesterday, or sort of flipped their filing yesterday. Just incredible growth in this period of time. Then you have at the other end of the spectrum companies that came to a halt, and what they did when that happened matters a lot. So, you know, Dana used the example of Spot Hero. I don't know the numbers there, but I know the company. Airbnb would be another example of that, and you can see that in their numbers now that they're filing as public. We have a couple of companies in our portfolio, and what we found with those companies are the ones that acted aggressively on the cost structure side of their business, whatever that meant. Significantly lower their cost structure. Their businesses, for the most part, have come roaring back, even with the stress of the pandemic dynamics that caused them to sort of slow down. But they're roaring back with a cost structure that's much more attractive than they had prior. And so, in addition to the growth, the operating margin characteristics or any of the margin characteristics of their business are stronger. And then you got a bunch of businesses in the middle that, it affected them. Maybe they lost a quarter in terms of growth dynamics for the year, but there's a lot of forecasting uncertainty. It's very difficult to know exactly what's going to happen. And so the only thing I'd sort of add to that mix is we're in that segmentation, we're shifting the planning horizon for companies. We have some companies with a traditional annual planning horizon. They're doing, everybody's in their annual budget cycle. We have other companies at the other end of the spectrum that are doing quarterly planning with a 12-month rolling forecast. And these are the companies that have, and again, there's sort of all different flavors of this, but it's focusing very much on understanding the inputs on the cost structure side relative to the outputs, even though the markets still seem to be rewarding growth regardless of your underlying cost structure, which I think, when interest rates are zero, maybe is true, but when interest rates are zero, might or might not be true. I'll let the economists in the room ponder that. So one other comment on this is, Stephen, your presentation was a good look backwards, and sort of justified financial performance from a look backward perspective. I presume that you teach your students that past performance is no indicator of forward performance, or whatever the cliche is.
Actually, in venture it is, but go ahead.
Well, great. I'm glad that that's become a truism now. I'm also, by the way, very glad to use median instead of average, because average is utter bullshit in any of these numbers and just completely useless. I think the interesting thing, which is the golden age discussion, is I think the next 20 years of this are going to blow away the last 10 years.
Oh boy.
No idea what that translates into in terms of value creation, but just in terms of the acceleration of all these changes, of which technology is an interwoven component of it. So
okay, I'm going to ask for a specific prediction at the end. So okay, that's that maybe a year, not 20, but go ahead.
I want to land on that in terms of what's happening right now, because I think a lot of people are very focused on month-to-month, quarter-to-quarter dynamics in the pandemic. And there's a lot of things that are happening that nobody is really able to scale out and understand. And I think you need to be able to scale out and understand those things as you're looking forward. And the question becomes, is the underlying characteristic really powerful? And it's easy to say yes to that. And so then all the perturbations sort of at the margin, are company-specific perturbations versus broader arc dynamics.
Interesting. Well, Brad Keywell, you're an operator and an investor. So what's happened with you? Looking backward, and then we're going to look forward.
Well, I'll stick with the Brad Feld groups of three.
A little louder. You're hard to hear, Brad.
Can you hear me now?
You're faint.
No?
Better. Good.
Okay. I'll talk as loud as I can. The dynamics I see. Can you hear me okay? Yeah.
Brad, no.
And you were good beforehand.
Can you hear me now?
You're cutting in and out.
I don't know. Can you is this okay right now?
Better if you get closer. Try getting closer. There you go.
So I'll do the best I can here. You got to give me a signal if you can't hear me. Okay, give me a second. Come back in a second.
We'll come back. Let me. We'll get back to Brad. So for the three of you who are here, what changes have you made because of COVID in looking at your investments now? Have you made it?
Can you hear me better?
Oh, there you go. Very good.
Okay, let's go back to my read. No?
You keep going in and out. It's very weird.
Try using you have a headset you can try to use? Okay.
No.
You could email Steve your answers and then he'll read them out.
I'll try to, I'm gonna try to read.
Can you dial in or go
Yeah.
dial in? There's a dial in number. Okay, so now, has it changed how you invest? What's been happening with your investment? And we'll go.
I'll answer first because I'm super brief on this one. Not really. Our strategy is unchanged, and my general view is you have to take a very long-term view, especially if you're relatively early entry points, and just be very consistent over a long period of time. So certainly learn a lot from different, in the moment dynamics that are going on, but I think our fundamental underlying strategy hasn't changed much.
Yeah, I'll echo what Brad said. I don't think the strategy has changed at all. We're still looking for companies that fundamentally understand customer acquisition, whatever that might mean in this day and age. I think what has been reinforced a little bit is that we're not looking for the obvious bets because of COVID. We're looking for the second, third, fourth level effects that might be coming down the road and making early bets on those, and really trying to pay attention to any shifting trends and dynamics that have happened that might fundamentally change things. And I think we have maybe some topics on that later, but that is what we're looking for, is not the obvious things like remote work. That's here, it's done. If you're getting in now, we need to adjust to those things. And there's going to be continuing tools that make that even better because so many people have been exposed to it now. But I do think that we're looking for second, third, fourth level effects.
So Steve, for me, my approach is a little bit different because I'm also a former operator. So the investments I make are often driven by just an interest in learning about a new space that I think will be important going forward. So for instance, I think the intersection of biology and all sorts of technologies is going to be huge in the coming years. So that's, to Brad Fels' earlier point, I think synthetic biology aided by things like AI, the advances in deep learning and neural networks, these technologies are already here. AI just seems to be a way of describing something in the future. Whereas if you look at your you look at your phone and things, it's embedded all around you. So there was a very interesting company I just invested in that actually uses AI to model cancer tumors. And they create computer models of cancer tumors and help physicians test drug efficacy on the tumor model instead of actually giving the actual medication to the patient and creating those sorts of risks. So there are so many examples like that. And I think the second one that I would say is a little bit earlier would be quantum computing. So many of you might know that Chicago has received 2 grants for setting up quantum computing research centers, and P33 recently held a couple of different day-long seminars. So, bit of an echo, I hear. Are you guys hearing an echo?
Yeah, you're back.
So both Chicago and Toronto, in this case, are becoming hubs for very interesting quantum computing companies. That's a bit of a blast into the future.
Very interesting. Brad, is there anything exciting you in particular?
Actually, would underscore something Dana said, which I think is really important for people to recognize. If you're excited about investing in video conferencing companies, the time to do that was 2015 or 14 or 13. If you're excited about investing in telemedicine companies, the time to have done that was probably 2015, 16, 17. You see a very rapid investment in the obvious categories whenever something like this happens. So one of the categories that's getting an enormous amount of investment all of a sudden is the virtual meeting as a replacement, or virtual event as a replacement thing. And I'm sure people on this call have been on, one of 9 different platforms that have become popular all of a sudden. And one of them just raised money at about a $2.5 billion valuation. Sort of very young company. That's fine. Like, that's normal in the world of venture. But the interesting dynamics is to start to think about what's coming from these things, and what the fundamental changes structurally in our society will be as a result of them. And I think that's a lot harder to understand, especially in the fall of 2020 or the winter of 2020, when the pandemic is not done. I mean, we're seeing, Colorado, I think, has record high hospitalizations as of yesterday, higher than in the spring. We have a federal government that's basically at this stage punted on dealing with it at all. And, maybe that'll change on January 21st. But the outcome of this pandemic is not at all known, even though the excitement around vaccines, as an example, have caused everybody to be, sort of optimistic. At the same time, it's kind of like technology hype cycles, right? The classic Gardner hype cycle, where you get this huge hype before things are real, and then as things start to be real, you have a deep trough, and then it steadies and builds. And so really, from my perspective, I'm looking for those things in the steady and build category. And interestingly for us, some of the places are either completely new technologies. We just made an investment, to link to quantum computing in a CU Boulder-based quantum computing company called Quanta. And it's a future speculative bet category that still is early. We're seeing incredible growth in companies in our portfolio, and very focused on what I would call bringing the industrial universe to the desktop. If you think about classical industrial manufacturing and facilities, if you can't get access to your facilities, or it's not safe to go to your facility, you still need to do that kind of manufacturing. And the distribution of that kind of activity, both on a hardware and a software basis, essentially to the desktop, not to the consumer necessarily, different in a lot of ways than shifts that we went through from mainframe to mini computer to desktop computing. We've got a lot of that kind of stuff going on that all of a sudden are second and third order effects of massively distributed work, and the elimination of consolidated infrastructure. Last one I'll give, it's an obvious one, but it's one that by no means is anywhere close to being resolved, is education. I think our entire educational system is on the verge of collapse.
Uh-oh, I'm out of a job, huh?
No, you're not out of a job, but the way classical education has been done, and we can separate K-12 from college. Let's just focus on K-12. Anybody on this call has kids. Are you happy with what's going on right now? And if you are, then I'm wrong. But if you're not happy with what's going on right now, it's not that this is April and everybody's scrambling to try to figure this out. We've had 6 months or 7 months to try to use infrastructure, software, technologies, tools, learning processes to be effective. And as far as I can tell from a distance, it's basically a disaster in the United States. And so the redoing and rethinking of education versus this optimistic or sort of, a phrase I despise, which is new normal, this idea that we're going to have the new normal. And somehow, there will be some changes, but we'll go back to January of 2020. This is wrong. I think we're going to be dealing with completely new modality that we haven't yet envisioned or figured out. But many of the things that we're doing right now are good examples of alphas or, minimum viable products, or bad things that we're just sort of patching together, but that will create the opportunity for re-envisioning complete broader trends for a long time.
Interesting. Well, let's see if we can hear Brad Keywell.
Can you hear me now?
Yeah, that's much better. So what's happened? So we have 2 questions for you. What happened to you, over the last few months, and what are you looking at going forward? So go ahead.
Okay, so I'll try to consolidate both the 3, speaking of my 3.
No, take whatever.
and the top of my head does exist, just the sun has decided to take it. Look, this has been a fascinating time operationally. Start with that. Technology companies are built fundamentally to be precise in operations. And the bump into people in the hallway rule that would suggest there's goodness to just wander around is not, notwithstanding that rule, what I notice as a net negative as an operator in the technology space is random conversations. What's a net positive is disparate activity that requires crisp, clear leadership. And so the disparateness of what's happening right now is an enabler of clear plans, of product roadmaps with integrity, of learning and A/B testing and round trip improvement with clarity. And it eliminates a lot of the excuse or a lot of the friction or noise that has historically interfered with the operational sort of cadence of technology companies. That's number one. Number two is, I think the risk equation in regards to technology has completely changed, specifically in the enterprise. Let's forget consumer for now, because we've been de-risking. Consumer's risk is to download an app and then delete it if it doesn't work. But an enterprise to make a decision around technology has historically been a risk-on proposition. And evidence of that is massive write-offs when things don't work as planned. If there was not the risk equation for the buyer who had to commit to a technology framework and an implementation plan and define specs and hope that it gets implemented appropriately, if that wasn't the case, there's no write-off. But that it has been the case is reflective of the naive or newness of technology and lack of understanding from the CEO, CFO, COO. It's been delegated to a CTO. That person makes a decision. The risk is what it is, and if it doesn't work, they write it off. So the risk equation has changed. Technology in the enterprise is now usable nearly immediately. You see major public companies like ServiceNow as an example of many who are reporting on quarterly calls days or weeks to implementation of average customers versus months or years. And SAP is an example, all due respect or with a nod to my friend Jay, the SAP and Oracle model is basically their customer is not the business, it's the systems integrator who is the one who's fundamentally selling that software. This idea of multiple layer, let's call it the enterprise software consulting or SI industrial complex is changing. And what's changing now is software actually works when you plug it in for companies, for the enterprise. And that is not a small deal. I would argue that's a colossally important deal, and it is the framework of the fourth industrial revolution. I think that the 4IR is way beyond that. There's sensors that generate data that help companies like Uptake do what it does. Fourth industrial revolution is saying you actually can buy software that works, and it works in lots and lots of different ways. It works radically well. It's like one-to-one delivery. Plug it in and fundamentally make more money, be better, smarter people, etc. So that's idea two. Idea three is the buyer of technology. To your golden age point, Steve, the buyer is now the leadership. It's the board. It's the mandator is the board. The buyer is the CEO, CFO, COO. The CTO is now a collaborative advisor. But historically, technology is a cost. You just spend money on technology so you can communicate or you can exist. But now the idea of we need to make more money, be better, open up more markets. We must make technology-related decisions. Those two things are inseparable. And with COVID, we now say you can't breathe without technology. So there was some point that said we have to adopt email because we have to communicate. And that was once revolutionary, or the golden age of email. Let's say there was once that idea. And so everyone buys an email system because you've got to have email. I would propose we're now in the golden age of technology, because if you want to be, period, or comma, if you want to be, you must be in relationship with technology at every level of everything you do. It's no longer this thing to do, it's what you do. And so the golden age is, it's no longer so golden. Technology itself is now, you have to have it in the operational surface area of your business and the information service area of your business. And that's one of my learnings, and I'll be done. But the idea behind Uptake is OT, operational technology, is not IT, information technology. The operations of your business are fundamentally different. They're connected too, but they're different than the information of your business. And so the idea of technology just is, and that you would historically have said, well, OT is something that the machine makers take care of. IT is what we focus on with our CTO. That would be an idea saying, I'm going to forget that half of my business because it just is what it is. We're going to focus on communicating well. Now technology can be deployed to operate well and communicate well. So golden age is that it's no longer golden. It's now
It is what it is. Now it's like e-commerce used to, it was a separate thing, and mobile commerce was a separate thing. Now it is business, right? It's all the same. So,
And Steve, if I might, there's a couple of really interesting implications to what Brett Keywell just said, which there's new user models. So I agree, like from the top, it's critical, and that's also driving a lot of new M&A. Because I think a lot of folks have woke up and decided that, the things that were technology trends a few years ago that they were starting to look at, all of a sudden are here, and they have to make different investments, and they know they don't have a good build strategy, so they're going to their buy strategy. And I think that's another shift that we're going to see coming in from the enterprise side around kind of the M&A activity and how that's going to continue.
I'll add one more thing to riff on Dana's.
Keep going, then I'll ask another question, maybe.
A big deal in my life. I wrote an article that got to Harvard Business Review. For a guy from Michigan, that's a big deal, especially with a dad who went to Harvard. And it was about the idea that boards, the committee structure of boards doesn't accommodate for technology. You have an audit committee, you've got a nomination governance committee, and you've got a compensation committee. You would argue that IT, like all of IT, all of data, all of everything would be part of audit. Where else would it go, right? But it's a tiny part. Audit is about literally the audit, the quality of the auditor and the auditing process, and then some cybersecurity risk versus some forward-looking technology opportunity. So the idea, what I propose, which is a data integrity committee, because at the heart of all technology is data that is actually representative of your truth. So whether it's that construct or otherwise, putting responsibility at a board level that you just are in relationship to technology deeply and fully as part of your corporate governance, corporate fiduciary responsibility. I think it's something like that has to happen, given that technology is business. Business is technology. There's no longer, should I use technology?
You're just doing it. So very interesting. Well, let me bring us back to investing and what you're doing. How do you do due diligence now? Like, is it different or is it just the same? So Brad, you said nothing changed, but do you invest in, do you care about the founders? Do you have to meet them?
So it's important to deal with history a little here to answer the question, because VCs are not, as you know well, Steve, but I think the question is important to underscore it this way. VCs are not a monolithic archetype. I think of them as Dungeons and Dragons characters. You've got some, you've got some wizards, and you've got some mages, and you've got some orcs, and you've got some trolls, and you've got some dwarfs. And firms are often collections of different D&D characters with lots of different experience levels. And one of the, so sort of using it not as a monolithic archetype, for us as a firm, a national firm that invests, everybody's based in Boulder, Colorado, we had to learn two things pretty quickly. One was how to travel a lot, and be comfortable with traveling a lot as VCs, which is something that some VCs are comfortable with and some aren't. But we also got very comfortable very early with remote interactions. And I'll just give one specific example that tells the whole story, which is we were an early investor in a company called Fitbit. We invested when they had about 10 people. I did not meet the two founders, James and Eric, in person until 6 months after we closed our investment. We decided to do the investment. I was at my house in Homer, Alaska at the time. I never met them in person, in the flesh. This is 2008 or 9 we made the investment, let's say 2009. But I spent a lot of time with them in advance, obviously via video conference as a way to get to know them. And you say, well, what was video conferencing in 2009? The answer is video conferencing has been around for a long time. This is not new shit. Totally the adoption and use and people's comfort with the adoption and use. So if you then fast forward to April of 2020, if you had said, again, in January of 2020, the entire office workforce of the world will be working from home and communicating via video conferencing, the person would have said, you're crazy. They would have said, deals can't get done. You can't sell anything to customers. Nobody will be able to buy anything. You can't hire people. You can't onboard new employees. You're not going to be able to communicate as teams. You know, none of that in-person stuff that companies have to do is going to work. And, you know, in April, there was this very strong sort of fear and discussion of, you know, will VCs be able to make investments without meeting entrepreneurs in person? And lo and behold, by June, as you saw from your graphs, the velocity of investing activity sort of snapped back. And it snapped back as a result of people deciding, you know what, I don't actually have to go invest. I don't have to go meet the people in person. I can still develop a relationship this way. That then has generated a very powerful second order effect. I encourage all the entrepreneurs out there to ask their VCs where they actually physically are right now, especially their VCs who were Bay Area based or New York City based or Boston based, or maybe even Chicago based. Because many of those VCs are no longer in those places. Some of their firms and some of their partners know it and some don't, and some of their LPs know it and some don't. In addition, all of a sudden, VCs are investing in a way that is very different than they used to. There was for a long time, and as long as I've been a VC, there's been this notion that if you're really serious about building a company, you needed to be in the Bay Area, which, you know, coming out of the global financial crisis in 2010, I declared very publicly that that was a load of nonsense. And much of my work on startup communities and Techstars and things like that has been partly validation of that being a load of nonsense. Of course, being in the Bay Area is awesome, and there's great things about the Bay Area, but there's lots of other places, witness Chicago, that are incredible places to build not just significant startup communities, but incredible companies. Today, all of a sudden, you're seeing investors recognize that, especially if they're US-based focused, the democratization of entrepreneurship and the sort of free movement of people and employees and companies and capital, because you're no longer in this mindset of, well, I have to physically be in person to make the investment decision. I have to physically be in person to be a board member. The company has to have a big office and everybody has to go to that office to get any work done. I think we're at the beginning of a very serious, you know, if you want to use a video game metaphor, unlock in the notion of capital and the way capital moves. Historically, at later stages, capital was pretty geographically mobile,
Right.
but early and mid stages, it was not. It has become incredibly mobile at the mid stage, and I think it's going to be incredibly mobile at the early stage as well.
That's very interesting. Let me ask Dana. Dana, you're a Chicago person, and you care a lot about the founders, is my sense. At least Troy does. Your partner. So how are you finding this? And do you agree with Brad?
Yeah, I agree with Brad in several aspects. I think I would just add, though, I think, you know, the founder relationship is the most important at the earlier stage companies. That's the idea morphs and change as you start to build. So we're looking for what does the founder bring to the table, and who does he or she surround themselves with, and what are the dynamics? What's the founder fit story? Why is that person the person to solve this very specific problem better suited than any other person? And I think so that has not changed. The importance of that fit at the earliest stages haven't changed. Now, the reality of that is that most founders that start early are sometimes founders that are very, very good at those earliest stages are not the founders that can scale and take a company, operating a company with 10 people, the way Brad was talking about with his Fitbit folks in the earliest stages, is very different than operating a global company with thousands and thousands of employees. And so you have to be aware that that founder may not be the person forever, but at the earliest stages, that fit is incredibly important. We are continuing to make lots of investments. We are having some of those most of those conversations virtually. I invested in a founder recently that I hadn't met one-on-one, and finally got to meet him. I had been talking to him for a while. Both my partners, Mark and Troy, previously knew him, so we had some things. I think making sure that you are aligned in terms of where the company wants to go, where you think it wants to go at those early stages are really important. But you're not really going to get the test of an entrepreneur until you've been in the trenches with them for a while. You've got to see how they react in good times and how they react in bad times, and how they adjust.
But you can get to know them on Zoom rather than meeting them in person then.
I believe that you can get to know them over Zoom. I don't think anything is as good as meeting in person. I'm somebody who I like to have a meal with people, or at least go to coffee with them. I like to see them interact with their teams in a way that tells me about leadership, that tells me about side jokes. And I'll tell a quick story. I had a founder, we had 4 or 5 in-person meetings with them. This was pre-COVID. 4 or 5 in-person meetings with them. They had presented to the team. We were leaning in, and I did a session with their team and saw the team tell misogynistic jokes in front of me about the founder's wife during the conversation. And I was like, peace out. Done. Not going to spend any more of my time or your time on this conversation. So there are certain things that you cannot see over Zoom, and you have to try to do more background, find the people. Don't call the 10 people that they tell you to call. Figure out the developed references. It's a small world. There's tools to do that with now. Like it's not going to tell you everything, but you have to be willing to read between the lines. And then the last thing I'll say is, the VC space, we argue about this. Is venture capital about taking risk, or is it about mitigating risk and trying to take risks off the table along the way? I think it's both. There's new uncertainty about that you have to deal with, and that's some of these dynamics of not having met people in person. But a lot of that you can get if you really do background on the person.
Interesting. Jay, you're an angel investor. Would you local, or would you go far away?
I'd go far away too. I made 3 or 4 investments over the summer. One was in India, so I've never met the people.
That's far away.
And that's far away. And the others were all by Zoom, so I've not met the people. I'm not quite as thorough as the other panelists here, because they are custodians of, in some cases, other people's money. So I tend to be much more focused on the individual, and why they actually want to do this, and how badly do they want to do this, and do they understand what they're getting into, and are they enamored with the idea of being an entrepreneur, or are they enamored with the problem? Because I prefer to see somebody who's actually really interested in that particular problem, as opposed to building a company. And you can tell a lot, even in a Zoom call, because you're looking at their face, and there's people's responses to questions are important. So that's probably, that's the main way I make the bet. And I would say, I've never seen an entrepreneur that's a subpar entrepreneur show up with a really good plan in a really good market. I mean, those things just don't happen. It's going to be somebody who's really dug into the problem and wants to do this. And to Data's point, the thing that you do miss is the team interactions. Those are harder to see.
Interesting. And Brad, you are in California. You're running a Chicago company, so.
I think that the later a company stage, the less in-personness is needed. I say that because I have firsthand knowledge of specifically of two transactions that were in the multi-billion dollar total value range, where the management teams did not meet in person, period, end of story. Because what was being assessed was the company, the integrity of the results, the numbers, and the fit strategically. And for better or worse, the acquisitions or mergers were both in consideration strategically of the asset and its accretive fit versus a bet on the people alone. Not that the CEO doesn't have relevance. I think the CEO is 100 times, the importance of the CEO as a definer of what a company is and is not, and what they stand for and what's unacceptable is beyond critical. I think that at a much earlier stage, back to Dana's point about having coffee with someone, I respect that perspective. I do think that the normalization of remote, of video conference, et cetera, has happily removed yet another friction source in the world. And as entrepreneurs, I suppose what I would offer is, as an entrepreneur, I think every ounce of friction that gets removed on Earth is net positive for humanity and for the activity of people. So perhaps it's my the only idea that I think was valuable in my economics classes in Michigan was that friction is a bad, or it's a thing that you prefer to not have. And the more frictionless our society, the more we can find a perfect balance where we can be, in essence, more in pursuit of, capable of reducing the imbalance of supply and demand, and also the imbalance of talent potential that gets reached versus capital or resources that are in search of those with potential and talent. So I look at our board experience. In my board experience, I'm on both public boards and private company boards, uptake and otherwise. And the ability of a board to interact with its operators is more fluid in a good way than ever. So I don't see many things, in fact, that have, other than mental health, separate conversation for a separate day. So one of the biggest unvalued or undervalued problems, from a valuable problem to address, that's been created by remoteness, is the mental health consequence. But other than that, in terms of operational and capital allocation capacity and sort of tenacity, I think that the remoteness has been a net positive across the board.
Very interesting. Okay, we've got, I think, 7 minutes left, so I've got 2 questions. The first one came from the audience, and they said, if you had $100,000, what would you do with it? I'll say $1 million, because 100,000 is too low for this group. So if you had $1 million to invest, where would you put it?
Well, I happen to have a couple million to invest.
What would you prioritize? Just,
Yeah, no, I think, I'm really, again, trying to see what's up and coming. There are a couple of things, I liken this back to when I first saw Slack very, very early, and got into a debate with my partner Troy about why is it better than email? Why is it better than text? Why is it better? Why? I feel that same way right now with what I'm seeing in some of the AR, VR spaces. And what's really interesting is that connection that people are getting as they go into virtual reality rooms and collaboration rooms. And, our venture partner, Neil Salas Griffin, is playing poker with his Techstars group to build some camaraderie that can't happen. So I think that is something that I'm starting to see a lot of adoption, starting with the consumer side. And what I'm most excited about is that adoption, transferring to the enterprise side, because that's where I spend most of my time, and looking for really key aspects of it that are very helpful and purposeful. And I tend to focus on things that are less gamey and more value creation in the world. And so I'm really excited about that area.
anyone else want to take that?
I'll go. I mean, just to go with a non-intuitive area, I think vocational training, education specifically designed to open new opportunities economically for people is underinvested in. I think education in generally is fully, not fully, but it's plentifully invested in. But vocational training, I think, is going to be less than ever the provenance of community colleges, even though they, I think, will step into that role and realize existentially that they need to be direct providers of more income to as a result of the engagement with a person in the community college. But the activity of enabling or facilitating or augmenting vocational training that directly results in a better income and a better set of opportunities for a person is an investable thesis.
I'll answer with a rhetorical rather than an answer, which is the first question I would ask that person that asks, what would I put $100,000 into, or what would I put $1 million into? My first question would now be, what is your goal? And the reason I'd ask that question is, is your goal to maximize outlier return value? Is your goal to preserve capital? Is your goal to get a at market return? Or is your goal to focus on societal benefit? Like, there's lots of different dimensions that you could go after. And I would suggest that that's a question I think people should be asking with their capital allocation decisions at kind of all levels of net worth. I mean, we're living in a moment in time where the inequities that exist have been dramatically amplified by this crisis. The inequities have existed, and now the extremity of that inequity is very visible. And a mathematical example or a market-based example is, I think, the increase in market value of the top 6 technology companies from the beginning of the pandemic to now is greater than the sum of the entirety of the small business economy in the United States. Yeah, Steve probably has better data than I do, but like
big number, whatever it is a very big number.
You sort of think about it from that perspective. It's like, okay, well, what actually is important to you as an investor over a long period of time? Do you care about that inequity, and do you care about and I don't want it to be a social good discussion, but the long-term dynamics of the interactive effects of how these things work. And I'll just tie that back to something that Brad Keywell said, which I love. I hadn't heard the phrases precisely before, so if I use it in a blog post, I'll have to remember to attribute to him. But the elimination of friction as a construct, one of the things that we know in tech and in investing is that there's massive gender and racial inequity given. We've been, as an industry, maybe making some progress on this with different levels of focus. But the efficacy of that progress is not necessarily one that you can say has eliminated inequity. And there's a lot of performative behavior and there's a lot of passive behavior versus active behavior. When you sort of then look at friction just in investment decision making, I would suggest that getting rid of in-person in that process gets rid of some of the bias that by definition gets introduced by in-person. And those biases are not just what people look like or what people smell like or how they interact with in person, but it's their actual functional ability to get to you if they are having to come to you to meet with you in person.
Interesting.
And we can go on for a long time.
We can go. So now I'll be the friction. So we have to start. I'm being told we're out of time, and Margaret will not be happy if I don't say thank you all for an awesome panel. And we actually could have got on. I asked half my questions and didn't get to ask some that I really wanted to know the answer to, but we'll have to do it next year. So thank the four of you so much for doing this and working through our technical issues. Thank Margaret, Ava, and Tina for putting this on, and have a great rest of the day, and everybody please stay safe. Thanks.
Thank you.
Thank you.
Thanks, everyone.